穿得大，上次那个。喂，小姐，什么人穿什么衣服啊？那都一时的啊，换家的都背一个子的。
Let's wait for more students to come to the room and we can start after a few more minutes. I think we can start the lecture now. Well, I understand some students might be a bit late, so I can, while waiting, while in the meantime, invite them in. Let me share my screen. Because we have really skipped one lecture when I was confirmed weeks ago. So that's why the syllabus has been delayed. Changed, updated for some reason. So and then they invited guests. Please keep your some students must still have some voice. Can you keep your silent? Let me try to get all of you to be silent. Sorry. Yeah, that's okay now. So today we're going to talking about the secondary housing mortgage and mortgage securitization. This presentation we're going to really make is try to give a brief outlook and review of the housing finance in terms of private sector. So you all heard hear about the subprime mortgages and why should we panic, right? And that's the subprime mortgages, context and background. So, but before we really go into the subprime mortgages, that's increasing, background that I wish to share. That is increasing demand for private housing finance with international trend. The point is why. Since in the 1950s, the global population distribution is around 29% versus 71, but this number has nearly halved in 2007. That's with urban population 49, but rural population was around nearly 51. So these are the changes with time between 1950 and 2007. But in the world's history, in 2050, perhaps the urban population would be 70%, while the rural would be 30%. And that's the rural and urban population distribution and redistribution. So due to this urban housing crisis and consequences of this, that's why we have this few very phenomenal consequences. The first one is the rent squeeze. You understand what is rent squeeze, right? Rent squeeze means we may go through a kind of housing rent crowding out. And also with the second issues, there would be fewer families that would buy a house. Some others would choose to rent, and even they're going to take from their parents, for example. And many people were squeezed out of urban housing market. There is another that we would consider. So many people would squeeze out of the urban housing market. And then the first one would be the urban homelessness. The case of urban homelessness is increasing. And the near homeless today are becoming tomorrow's homeless. That's another, attribute that should be paid attention. So with this figure that you can see the whole logic of the global housing, logic. From left-hand side, the housing policy would be established, but under the political environment, under the micro stability and the legal and juridical environment, and also the transparency and disclosure. So that is one particular, micro background before the policy was established. And then we can see the legal and the regulatory framework, which include institutions, the markets, institutions, and the contracting and rules of conduct, and the failure resolution laws. So these are the 4 specific regulatory framework. For the case of institutions, we all understand that will include a lot of business and commercial companies, some central banks and insurance companies, and pension funds, for example, and also the nature fund management, for example. And another one that would be some markets, which include the capitals in the markets, and then also the housing security trading firms and investment fund and management firms. This is market rules by using under the legal and regulatory framework. And the contracting and rules of conduct. That is one we would say that under this contracting and rules of conduct, we can see the property rights and lending collateral and financial instruments, as well as we can see a lot of market conduct, the wholesale and retailing rules, and in terms of investment services, etc. And we can see a lot of accounting and auditing with the regulation rules. The financial sector infrastructure would include, we can see the banking and other financial supervision. This is fundamental, we say the softer side of financial infrastructures. And we would have a lot of accounting and actual professions and the payment systems, etc. And the property right registries and the share registries and rating agencies and market research and valuation, etc. So this is a financial one. And in the meantime, we can see that a lot of development, institutions should be incorporated. Like we say, the companies and also the central bank, and also some of the local and regional commercial banks, like they're either specialized commercial or cooperative and microfinance. The first one is a contractual 7 that include insurance, pensions, etc. And in the capital markets, we can see a lot of securities, right? Securities, the exchanges for the kind of equities, bonds, and also some other, the government, the bonds would come from the government, also some municipal in the states, and also corporate housing bonds, etc. So there are a lot of developmental institutions that have been put into the, global, markets. And then financial instruments would include the leasing, housing loans, agriculture credits, suppliers credits, and some more guarantees, etc. We can also see a lot of fixed income instruments and some currencies and commodities, etc. So these are the financial instruments. And we can see a lot of upgraded skills like professional associations, the training institutions, some seminars for policymakers, and institutional development and training programs, etc. So these are the main, important, regularities for the kind of the system into the global housing. So if we look at this from the global trend, we can see that besides the market, housing in the mainstreaming into this part, there are also some lower income housing. Some of them in UK, they put this social housing funds, but there are a lot talking about the not only social housing, but also the private and also public housing sector funds. So, but when we're talking about the main housing market, we can see that may include the treasury, the central bank, and also secondary mortgage market. That's what we're going to introduce today. But of course, we have a lot of primary market that may incorporate deposit banks, the financial banks and companies, etc. So this is a treasury and central bank classification. The right-hand side is the international capital market, which includes the World Banks or international financial institutions, IFI, right? So this is international. And then after that, we're going to talking about how does the other, developmental would include like the domestic capital market, the institutional investors, individual investors, etc. And then the term saving would have the pension plans, the life insurance, etc. And we can see also some other, term savings, which we have the mutual funds. You can easily identify some mutual funds. And when we refer to the main and low housing, the secondary mortgage market is considered as one of the important, we say the, in terms of the funding, that is one important channel for that. But once again, if we want to look at the housing finance policies, that we would see from how it needs to be consistent with the other, and we can see that the Treasury Central Bank, which include the micro and economic demand management, and also the fixed income securities market, which have, we say, the domestic capital market sector. So, and also the major focus on the pension and insurance reform, etc., etc. So these are the, we have the, once we talk about the financial system, you may have the financial infrastructure, and also the software systems, and also, we need to have the policies. All of this would make it into a system, globally system, right? So, but when we are talking about the forms of the different housing, formality, for example, the social housing, and we have the kind of a new subsidy design, the market focused regulations, and the restructured state institutions, and the retail banking, for example, which include the consumer finance plus of course lending. And for the term savings, we can see a lot of pension plans, life insurance, the mutual funds. They are more focused on the pension and insurance reforms, etc. And then we can see, the depository institution that originates loans, and which would include, firstly, if they hold in portfolio, and afterward they would issue the mortgages bonds. And for the non-depositive institution that originates loans, that would sell the loans. So both of these two would go to the investor, and also the secondary market institution or conduct. So all of the secondary market institution or conduits, they would sell the whole loans to the investors, by the way. So this would become their selling actions or behaviors. And then after that, the secondary market institution or conduit that would pool their loans into the mortgage, mortgage-backed securities. And for secondary market institution or conducer, they would also issue the mortgage bonds backed by the loans. So firstly, when the loans were pooled into the mortgage-backed securities with MBS, that would sell this MBS to all the international or local investors. So these considered was one of the important packages for the MBAs. Once they decided to issue the mortgage bonds that is backed by loans, that would sell the bonds to all the investors. So that's how we look at the varieties of loan originators that will reflect the diversity of national system with significantly different all-in costs and degrees of overall efficiency. And this is based on the expanding investor bases like the public pension funds and private pension funds and life insurance companies and mutual funds, commercial banks, and specialized lenders. So those would make the investor base would have a wide and variegated basement for MBAs and for the loans originates. So this is great mortgages. Now, when we refer to securitization process, so let's try to give a briefer introduction of the definition. The securitization is considered as a structured financial process. They include the pooling and repackaging of cash flow producing financial assets into securities that are then sold to the investors. And a mortgage-backed security in this context is considered as a asset-backed security whose cash flows are backed by the principal and interest payments of a set of mortgage loans. And the total market value of all outstanding US MBS at the end of the first quarter of 2006 was approximately $6.1 trillion actually. So if they try to give a definition for the securitization process, we can kind of make it into portrayed as a financing mechanism. Which means it would transfer the financial assets from their own originator from this that goes to a special purpose entity. So we name it as SPE. That in turn will fund the acquisition by issuing publicly rated securities to various parties. So this is a process. So if we use this a bit of typology and also the figure like, and if suppose we have three stakeholders in the left-hand side, we have lender, we have the issuer, we have investors. So they are the three main stakeholders. And if in the mortgage, we have the mortgage broker, right? Mortgage broker, this is considered very important, stakeholders for mortgage broker. And with that, we can also see the borrowers that would make this an important, configuration of that for the servicer, which include the loans with the monthly payment and with the borrowers and with the monthly, the server. But under the issuer, they must guarantee with a few specific trustee, underwriter, rating agency, and the credit enhancement provider. So, but some of you might inquire about the 4 steps, which include generally step 1, the borrower would obtain a loan from a specific, lender, and this would make it be done with help from mortgage broker. That's what the mortgage broker helps. And then the second one is the second step is the lender would sell the loan to the issuer, and the borrower begins making monthly payment to the servicer, So this is the second step. The third step would be the issuer will sell their securities. Sorry, can you try to keep your silent? Someone talked just now, and let me try to give. Please try to make sure that your is silent mode, okay? Then if we define the definition for the advantages of this, advantages is the definition of the securitization and the process of the securitization. We can also see the advantages of the securitization. For one hand, we would say that it will help reduce the asset liability mismatch. You understand, right? Securitization, the process of that, because that could make the liability book or the funding in most banks and finance companies is from the borrowing, and this would often comes at a very high cost. The second one is they could help lower the capital requirements. With some firms, that is due to the legal, regulatory, or other reasons, have a limit or range that their leverage that is allowed to be. So the securitization of the assets could help qualify them, as a kind of sale for accounting purposes. You understand what is accounting, right? For accounting. So this would matters. For another potential important issues that we would map, that is the locking. We put a locking, we also make it not only that it should be past dependence profits. So once a block has been securitized, the level of profits has now been locked in for that company. Thus, the risk of the profits would not emerge, or the benefit of a super profits has now become passed on to the next stakeholder somehow. So this is how the advantages of securitization would be measured. The fourth one would be the transfer risks that include the credit, liquidity, prepayment, reinvestment, asset concentration, etc. And this securitization will make it possible to transfer the risks from an entity that does not want to bear it to one that does. The portfolio diversification is the fourth attributes. If we say it will depend on the securitization, hedge funds, as well as the other institutional investors tend to like investing in the bonds created through the securitization because they may be uncorrelated to other bonds and securities, etc. So this is a portfolio diversification. Then we have to really make the three concepts on mortgages quite clear. What is different between the subprime mortgage, the secondary mortgage, and also the refinance, right? So we have to differentiate. Subprime mortgages is quite clear. When we say the subprime, it refers to the loans that does not meet Fannie Mae or Freddie Mac guidelines according to American. And this is generally due to one or a combination of factors, including the credit status of the borrower, the income and job history, and income to mortgage payment ratio. And for Fannie Mae, well, that's how we look at this for Fannie Mae's guidelines. We can see that the Fannie Mae's National Mortgage Association was established at first beginning. And it was founded in 1938 during the Depression. It is chartered by the Congress in 1968 as a GSE. Another interesting attribute is that it does not make home loan directly to consumer, but it will use the secondary mortgage market to facilitate the liquidity in the primary mortgage. That funds are consistently available to the institutions that do lend money to the home buyers. So this is a false attribute. And the subprime borrowers, they have a heightened perceived risk of default, such as those who have a history of loan delinquency or default, and those with recorded bankruptcy, or those with a limited debt experiences. So though there is no standardized definition in the US subprime loans that are usually classified as those where the borrower has a credit score below a particular level, for example, a FICO score below 660. And if we make example of subprime mortgage, so here are the bulletin points. First one, would you like a mortgage that lends you more than value of your house? Right, this is point one. The second question is, would you like it structured so that your first payments are extra low? And if the mortgage won't structure that way, would you be unable to afford the payments? And are you convinced that the real estate prices will continue to rise? And do you have a poor credit history? So all of these are considered example of attributes or characteristics of subprime mortgages. And that's all the questions for ideal target for subprime mortgage lender. But we have mentioned the three concept differentiation. So this is very important in terms of this. We would say that firstly, the secondary mortgage market is a market for the sale of securities or bonds that collateralized by the valuable mortgage loans. And the subprime mortgage market includes the primary mortgage and secondary mortgage markets, which relates to the mortgages with high risks on the repayment. And refinance means it refinanced the housing asset for a secondary time in the primary market. And the securitization would have the MBS and CDO. So if we put a mortgage-backed security, it means a bond whose cash flows are backed by the principal and interest payments of a set of mortgage loans. This is MBS. And CDO, the full term is the collateralized debt obligations, which is an unregulated type of asset-backed security and structured credit product. So the CDOs are actually constructed from a portfolio of fixed income assets. And these assets are divided by the ratings firms that assess their value into different tranches. And LIBOR is the third one. LIBOR, you might read newspapers, a lot of LIBOR concept. That means London bank office, offer rate. It means the standard rate of interest for loans between the financial institutions. So here is the class A, B, C, D, and as you can see, the ratings are fluctuated from 3A, 1A, 3B, 2B, and then R. So that was considered typical CDO's tranche structure. So according to the different CDOs, you can see that different borrowers and lenders have the different tranche hierarchies. So the loss will be higher and the loss will have more credit. The more credit, the more credit risk, the higher risks it will have be. So that's the CDOs. The first issue is the credit default swap, and that is CDS. So in the last slides, the last change, we said non-rated in some form of equity is considered very risky. For example, the toxic waste. And what do banks do with the toxic waste? If we suppose buy the insurance and we pay the insurance premium to another financial institution for underwriting the risk of the toxic waste. And this is one form of credit default swap. And the financial institution will receive the premium regularly, which would package this and sell the insurance premium on toxic waste as synthetic CDOs. So this is a third, CDOs issues. And for the subprime mortgage crisis, the things that would make you may have some interesting, metaphor of this, a black swan. Nicholas and Nassim Taleb, he referred to the black swan, right? So that's why we make it a black swan phenomenon, that we say no amount of observations of white swans can allow the inference that all swans are white. But the observation of a single black swan is sufficient to refute that conclusion. So put another way, that such kind of black swan phenomenon can trigger an important question, that is, do you consider the black swan and white swan problem as considered a problem? And what is black swan? First and foremost, it is an event. Secondly, it's hard to predict based upon the historical data. And after the event, many people will saw it coming. And we can see a lot of stress models that assume the black swan event to ensure the great predictable power. The subprime mortgage crisis, we say, is an ongoing financial crisis that triggered by significant decline in the housing price. And it is related to the mortgage payments, delinquencies, and foreclosures in the states. And this would cause a ripple effect across the financial markets and global banking systems, because investments related to the housing prices declined significantly in value. That would praise the health of the key financial institutions. We see the Lehman Brothers and government-sponsored crisis. We said GSE like Fannie Mae and Freddie Mac at risk. So this is how it is ongoing, and how does it trigger the whole financial crisis, subprime. So once the crisis began with the bursting of the United States housing bubble and high default rates on the subprime and adjustable rate mortgages, which it would begin in approximately 2005 and 2006. So the government policies and competitive pressures for several years prior to the crisis would encourage higher right and risk lending practices. And there's an interesting cartoon showing how and why once economy have the bubble and subprime mortgages, it looks like firstly the housing price would falling down. That falling housing price like the apples, and the governments would have to clean it up. And then we have to really understand there are major causes for the housing bubble. So firstly, we have the mania for home ownership. And secondly, is historically low interest rates, and very risky mortgage products and lax lending standards. And also we can see a lot of speculative real estate, speculation fever. So that's quite important causes. And for the borrowers, we can see the refinance. So further, when the increase in the loan incentives, such as easy initial terms and long-term trend of a rising housing prices, had encouraged the borrowers to assume difficult mortgages in the belief that they would be able to quickly refinance at more favorable terms. So once the interest rates began to rise and housing price started to drop moderately in 2006 and 2007 in many parts of the US, the refinancing became more difficult. So some homeowners were unable to refinance and began to default on the loans because their loans would reset to higher interest rates and payment amounts. So this is from borrower perspective. And so that's how we see the American dream would make it. Like if we compare the US homeowner rate, and you can see how it drops. But before 2006 until 2008, they have climbed up and suddenly dropped in 2008 early years of 2008. And this is how the housing price dropped. And then the real, salary, not the in the name, but real salary growth up and down fluctuated. And the lenders would have offered increasingly higher risk loan options and incentives. So one of the particular example is the interest-only adjustable rate mortgages that we said ARM. Second one is the payment option that a homeowner could pay a variable amount, but any interest not paid is added to the principal. So this is the lenders. For the MBS, Well, we can see that the financial products were called mortgage-backed securities, which would derive their value from the mortgage payments and housing prices. This had enabled the financial institutions and investors around the world to invest in the US housing market. And the major commercial banks and also some other institutions, and that means not only in the government, but also a lot of financial institutions had borrowed and invested heavily in MBAs, and they have reported the loss of approximately 435 million US dollars as to the July 17, 2008. So this is MBAs, right? And then the liquidity declined. So all the funds available for personal and the business spending, the liquidity declined as the financial institutions tightened the lending practices. And the crisis, which has roots in the closing years of the 20th century, but has become more apparent throughout 2007 and 2008, has passed through the various stages, exposing the pervasive weaknesses in the global financial system and regulatory framework. So this is the liquidity has become declined, and we say they dropped. So here's the Lehman prices that see the credit start from the CDS, and that leading the crash of 2008. So when Lehman Brothers went bankrupt, around $500 million was owed to CDS protection owners who have hedged against the bank. So the actual amount swapped and amounted to around 7.2 billion. This was the New York Times that have shown the CDS. And for the defaults and foreclosure, the defaults and foreclosure activity actually increased dramatically because the easy initial terms expired and the home price failed to go up as anticipated. And ARM interest rates have reset higher. The foreclosures have accelerated in the States in late 2006 and has triggered a global financial crisis through 2007 and 8. So during 2000, if we're dating back to the years 2007, nearly 1.3 million US housing properties were subject to foreclosure activities, which is up to 79% from 2006. So this is we have to go back to the historical moment. And then, well, if we really made, some actions, and central banks, and some governments, we can see the lenders first. This is lenders, because we see the liquidity and solvency, concerns regarding the key financial institutions have drove the central banks to take action to provide funds to banks to encourage the lending, to worthy borrowers, and to the restore faith in commercial paper markets, which are integral to funding business operations. And the governments also bailed out the key financial institutions, such as 85 billion emergency loan to the AIG, which assume significant additional financial commitments. So this is lenders. The second issue is the good cut. The interest arrest and economic stimulus packages, etc. So the risks to the broad economy created by the housing market downturn and subsequent financial market crisis were primary factors in the several decisions by the central banks around the world to cut interest rates and governments to implement economic stimulus packages. So all of those actions are designed to stimulate economic growth and inspire confidence in the financial markets. So this is the interest rates. And the over liquidity of lower interest rates will submerge the housing market. So this is low over liquidity, phenomenon. The causes. Next chapter, we're going to introduce the causes of subprime mortgage crisis. Before we start, I would like to take a short break, around 10 minutes around, and we come back soon. Okay. Hello. Welcome back. Now the students ask some questions. I want to answer you first. So the content of the lecture, because the lecture 13 we will going to have a revision for Q&A. And we will go through from the several lectures that will not spend many long time, and we will arrange some Q&A session. And also for the examination, it will be arranged because this year we changed to exam, so it will be online examination. So that will be closed book examination. Okay, the PPT of this lecture and last lecture will be uploaded after tonight's, perhaps tomorrow. So don't worry for that. Any more questions for the examination? So I understand some students write to me saying they're going to have some quarantine, that will segregated quarantine. So I think that was arranged on the class lecture 13, because now we changed the lecture 13 into the online examination on May the 6th. So I think you might have time to prepare for that. So let me start, go on with our lecture now. Subprime mortgages. The causes of the subprime mortgages. Because the housing downturn that incurred bring along excessive supply of the home inventory, and that also bring along the sales volume of the home new housing dropped. This would have reduced the market price by 10.4% in the past year. And the foreclosure rates has also increased. And for the borrowers, we can see that bring along a lot of difficulties in the refinance. And this would begin to default on the loans, the borrower's perspective. And they would walk away from the properties with fraudulent misrepresentations from the borrower. From the financial institutions, that would help attract from the higher returns, that would also offer high-risk loan and incentives. And this would make them believe that it will pass on the risk to others. So these are the main, from the financial institutions. If we put the securitization that mortgage-backed, was we have mentioned just now, the mortgage-backed, securitization. That's another, kind of security MBA's, rules. And all of the potential MBS securitization-driven securitization risk would readily transfer to the other investors. This would start from 54% in 2001 to 75% in 2006. And mortgage underwriters. We all understand that all the underwriters will determine if the risk of lending to a particular borrower under the certain parameters is considered acceptable. And the majority of the risks and terms that underwriters consider would fall under the 3 C's: credit, capacity, and collateral. So in 2007, 40% of all the subprime loans were generated by the automatic, underwriting. And the real risk of subprime loans were not taken seriously in the primary lending market. And for the credit rating agencies, they are now under the scrutiny for giving the investment trade ratings to securitization transactions holding subprime mortgages, etc. So the conflicts of interest were involved as the rating agencies are paid by those companies that sell the MBS to investors, such as investment banks, etc. And the rating cannot accurately reflect the risk of the subprime MBS, especially the CDOs. And for the government and regulators, we can see the community, the community level, they have initiated the Reinvestment Act that have encouraged the development of the subprime debacle and a lot of Glass-Steagall Act that contribute to the subprime mortgages. For central banks, that is, initiated from Federal Reserve, that firstly was less concerned with the avoiding asset bubbles. And secondly, that would also have encouraged the moral haphazard. The Federal Reserve kind of actions or act would raise concerns amongst the market observation that it could create a moral hazard. And the second one is involvement in the rescue of long-term capital management in 1998. That would encourage large financial institutions to assume more and more risk. This would have lowering of interest rates to diminish the blow of the collapse of the dot-com bubble, the internet, right? To combat the risk of deflation, the Federal Reserve lowered the federal funds rate target from 6.5% to 1.0% from 2000 to 2003. And then another one is list determination on the monetary policy, and institutions' risk have become more a threat rescue. And another one is a chain effect leading to a crisis. Firstly, the housing bubble. Secondly, the surge in defaults and foreclosures. The third step is housing prices fall and the prices of MBS plummet. The fifth one is the loss of financial institutions. Like we have said, a lot of financial institutions that have too little capital and too few assets compared with their debt, which we would say that this problem is especially severe because everyone took on so much debt during the bubble years. So all the financial institutions we name as FIs have been trying to pay down their debt by selling assets, including those mortgage-backed securities. But we would say that this would help drive, the asset prices down. Because no one else is buying due to lack of confidence and lack of liquidity. And this will start from item three, housing price start falling like apple trees again. So this become a vicious cycle that what we call paradox of deleveraging. So I also get this housing bubble formation for your potential understanding, right? With the lending decisions by institutions, we can see the government-sponsored institutions mortgage buying, the practices would start, and that will bring along the political influence with government objectives regarding the lower income housing. And the second pillar is the bank lending practices with investor demand for MBAs. And as a securitization and credit risk insurance. And with that, the third one is the capital and credit availability that would ping-pong the low interest rates and tax cuts. I won't go through the detail, but you can see that from the lending decisions by the institutions. With the right-hand side is the borrowing decisions by individuals. We can see both of them with a lot of high-risky products or decisions that is done by borrowing decisions with individuals. The second one is once the housing bubble starts, will bring along excessive housing inventory, and housing price would triggered by the declining. And this would bring along the inability to refinance mortgage. And with the mortgage delinquencies and foreclosures, and negative effects on the political and social economics. So that will bring along, some phenomenal, we say, consequence from home building declines, the downward pressures on the consumption as household wealth declines, etc. So this will bring along the mortgage cash flow declines that bring along commercial banks losses, and the bank capital levels depleted, and was also driven the bank failures and liquidity crunch for businesses, etc. And then the negative effects on the economy. So this is start from the housing market that bring along and the financial markets burst. And the third pillar is the government industry responses. So since we have seen a lot of downward pressure on the business environment that bring along the risk of increasing unemployment, and also the stock market declines that will reduce household wealth, that bring along the central bank actions. That is also, we say, the physical stimulus packages that met homeowner assistance. So this is government and industry responses that bring along the one-off bailouts. So that would bring on systematic rescue in the end. But from another aspect, impacts of the crisis should also be bare. So how about impacts? Here are the conflict effects on the global stock market. So first and foremost, we can see obvious effects on the global stock markets due to the crisis that have become even more dramatic. So between January the 1st and October 11, 2008, the owners of stocks in the US corporations has suffered about $8 trillion in losses as their holdings declined in value from 20 trillion to $12 trillion. So that is bring along the loss in the other countries that have averaged about 30%. So that's first effects. And for the financial institutions that bring along a lot of bankruptcy, like we said, the USM case of New Century Financial, American Mortgages. So these are a lot of bankruptcy cases. The second issue is the pressure on commercial spending. That met the loss in the stock markets and housing value declines with further downward pressure on consumer spending as considered a key economic engine. And the leaders of the large developed and emerging nations, we name as G20, they met in November 2009 to formulate strategies for addressing the crisis. And these are also the other economic conditions, problem, recessions, very low GDP growth rate, and business close out or lose money. And the other credit markets like credit cards and a lot car loans. And the investor will be very cautious to act. And they start to have become lack of confidence in the stock market or bond market as well. Sorry, there's a typo here. And consumer spending will slow down and lack of cash, etc. So that is how it looks like this. I also prepared a interesting, video for you to share.
A little different. We're going to explore one moment in history in depth. We're going to talk about how the 2008 financial crisis and the government response to it in the United States.
So let's get started. The 2008 financial crisis was a big deal. Ben Bernanke said it could have resulted in a 1930-style global financial and economic meltdown with catastrophic implications. But what happened? Why did it happen? And why aren't we all huddled around burning trash cans, forming a raiding party to go steal gas from other tribes in the wasteland? By the way, if you're actually doing that, you probably didn't hear we survived the financial crisis. Things got better. Seriously, put down your crossbows.
To explain what happened, first we have to do a quick explainer about mortgages. And you might already know this, but basically someone that wants to buy a house will often borrow hundreds of thousands of dollars from a bank. In return, the bank gets a piece of paper called a mortgage. Every month, the homeowner has to pay back a portion of the principal plus interest to whomever holds the piece of paper. If they stop paying, that's called a default, and whomever holds that piece of paper gets the house. The reason I'm saying whomever holds the paper rather than the bank is because the bank, the original lender, often sells that mortgage to some third party. And the reason I say often is because this happens all the time. I've had my house for 9 months and 3 different banks have had the mortgage. Traditionally, it was pretty hard to get a mortgage if you had bad credit or didn't have a steady job. Lenders just didn't want to take the risk that you might default on your loan. But all that started to change in the 2000s. And before we go further, a quick aside here. The story gets complicated fast, and it's a fascinating story, but we're trying to keep it relatively simple. So I've asked Stan if we could put some additional resources in the YouTube description. And Stan said yes. Thanks, Stan. Anyway, back to our story. In the 2000s, investors in the US and abroad looking for a low-risk, high-return investment started throwing their money at the US housing market. The thinking was they could get a better return from the interest rates homeowners paid on mortgages than they could by investing in things like US Treasury bonds, which were paying very, very low interest. But big money global investors didn't want to just buy up my mortgage and Stan's mortgage. It's too much hassle to deal with us as individuals. I mean, we're pains. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities are created when large financial institutions securitize mortgages. Basically, they buy up thousands of individual mortgages, bundle them together, and sell shares of that pool to investors. Investors gobbled these mortgage-backed securities up. Again, they paid a higher rate of return than investors could get in other places, and they looked like really safe bets. For one, home prices were going up and up. So lenders thought, worst case scenario, the borrower defaults on the mortgage, we can just sell the house for more money. At the same time, credit ratings agencies were telling investors these mortgage-backed securities were safe investments. They gave a lot of these mortgage-backed securities AAA ratings, the best of the best. And back when mortgages were only for borrowers with good credit, mortgage debt was a good investment. Anyway, investors were desperate to buy more and more and more of these securities. So lenders did their best to help create more of them. But to create more of them, they needed more mortgages. So lenders loosened their standards and made loans to people with low income and poor credit. You'll hear these called subprime mortgages. Eventually, some institutions even started using what are called predatory lending practices to generate mortgages. They made loans without verifying income and offered absurd adjustable rate mortgages with payments people could afford at first, but quickly ballooned beyond their means. But these new subprime lending practices were brand new. That meant credit rating agencies could still point to historical data that indicated mortgage debt was a safe bet. But it wasn't. These investments were becoming less and less safe all the time. But investors trusted the ratings and kept pouring in their money. Traders also started selling an even riskier product called collateralized debt obligations, or CDOs. And again, some of these investments were given the highest credit ratings from the ratings agencies, even though many of them were made up of these incredibly risky loans. While the investors and traders and bankers were throwing money into the US housing market, the price of homes in the US was going up and up and up. The new lax lending requirements and low interest rates drove housing prices higher, which only made the mortgage-backed securities and CDOs seem like an even better investment. If the borrowers defaulted, the bank would still have this super valuable house, right? No, wrong. Let's go to the thought bubble. Actually, let's go to the housing bubble. You remember bubbles, right? Rapid price increases driven by irrational decisions. Well, this was a bubble, and bubbles have an annoying tendency to burst. And this one did. People just couldn't pay for their incredibly expensive houses or keep up with their ballooning mortgage payments. Borrowers started defaulting, which put more houses back on the market for sale. But there weren't buyers, so supply was up, demand was down, and home prices started collapsing. As prices fell, some borrowers suddenly had a mortgage for way more than their home was currently worth. Some stopped paying. That led to more defaults, pushing housing prices down further. As this was happening, the big financial institutions stopped buying subprime mortgages, and subprime lenders were getting stuck with bad loans. By 2007, some really big lenders had declared bankruptcy. The problem spread to the big investors who'd poured money into these mortgage-backed securities and CDOs, and they started losing money on their investments, a bunch of money. But wait, there's more. There was another financial instrument that financial institutions had on their books that exacerbated all of these problems. Unregulated over-the-counter derivatives, including something called credit default swaps that were basically sold as insurance against the default of mortgage-backed securities. Does AIG ring a bell? It sold tens of billions of dollars worth of these insurance policies without money to back them up when things went wrong. And as we mentioned, things went terribly wrong. These credit default swaps were also turned into other securities that essentially allowed traders to bet huge amounts of money on whether the values of mortgage securities would go up or down. All these bets, these financial instruments resulted in an incredibly complicated web of assets, liabilities, and risks, so that when things started going bad, they went bad for the entire financial system. Thanks, Thought Bubble. Some major financial players declared bankruptcy, like Lehman Brothers. Others were forced into mergers or needed to be bailed out by the government. No one knew exactly how bad the balance sheets at some of these financial institutions really were. These complicated, unregulated assets made it hard to tell. Panic set in. Trading and the credit markets froze. The stock market crashed, and the U.S. economy suddenly found itself in a disastrous recession.
So what did the government do? Well, it did a lot. The Federal Reserve stepped in and offered to make emergency loans to banks. The idea was to prevent fundamentally sound banks from collapsing just because their lenders were panicking. The government enacted a program called TARP, the Troubled Assets Relief Program, which the rest of us call the bank bailout. This initially earmarked $700 billion to shore up the banks. It actually ended up spending $250 billion bailing out the banks and was later expanded to help automakers, AIG, and homeowners. In combination with lending by the Fed, this helped stop the cascade of panic in the financial system. Treasury also conducted stress tests on the largest Wall Street banks. Government accountants swarmed over bank balance sheets and publicly announced which ones were sound and which ones needed to raise more money. This eliminated some of the uncertainty that had paralyzed lending among institutions. Congress also passed a huge stimulus package in January 2009. This pumped over $800 billion into the economy through new spending and tax cuts. This helped slow the free fall of spending, output, and employment.
In 2010, Congress passed a financial reform called the Dodd-Frank Law. It took steps to increase transparency and to prevent banks from taking on so much risk. Dodd-Frank did a lot of things. It set up a consumer protection bureau to reduce predatory lending. It required that financial derivatives be traded in exchanges that all market participants can observe. And it put mechanisms in place for large banks to fail in a controlled, predictable manner. But there's no consensus on whether this regulation is enough to prevent future crises.
So what have we learned from all this? Well, one key factor that led to the 2008 financial crisis was perverse incentives. A perverse incentive is when a policy ends up having a negative effect opposite of what was intended. Like mortgage brokers got bonuses for lending out more money, but that encouraged them to make risky loans, which hurt profits in the end. That leads us to moral hazard. This is when one person takes on more risk because someone else bears the burden of that risk. Banks and lenders were willing to lend to subprime borrowers because they planned to sell the mortgages to somebody else. Everyone thought they could pass the risk up the line. The phrase "too big to fail" is a perfect example of moral hazard. If banks know that they're going to be bailed out by the government, they have an incentive to make risky or perhaps unwise bets. Former Fed Chairman Alan Greenspan summed it up really nicely when he said, if they're too big to fail, they're too big.
When something terrible happens, people naturally look for someone to blame. In the case of the 2008 financial crisis, no one had to look very far because the blame and the pain was spread throughout the US economy. The government failed to regulate and supervise the financial system. To quote the Bipartisan Financial Crisis Inquiry Commission report, the centuries were not at their post, in no small part due to the widely accepted faith in the self-correcting nature of the markets and the ability of financial institutions to effectively police themselves. The report placed some of the blame on the years of deregulation in the financial industry and blamed regulators themselves for not doing more. The financial industry failed. Everyone in the system was borrowing too much money and taking too much risk, from the big financial institutions to individual borrowers. The institutions were taking on huge debt loads to invest in risky assets, and huge number of homeowners were taking on mortgages they couldn't afford. But the thing to remember about this massive systemic failure is that it happened in a system made up of humans with human failings. Some didn't understand what was happening. Some willfully ignored the problems, and some were simply unethical, motivated by the massive amounts of money involved. I think we should give the last word today to the Financial Crisis Inquiry Commission report. To paraphrase Shakespeare, they wrote, "The fault lies not in the stars, but in us." Thanks for watching. Crash Course Economics is made with the help of all these nice people.
So this
We're
one
able
has
to save off our
basically
own-
give kind of interest, very interesting, cartoon-like simplified for the housing subprime mortgage crisis. That really, if you still have interest, you can click on the crash course for the 29 and 208 subprime mortgages. So that's all for today's session. Any more questions regarding to the lecture slides? You can open your mic if you have any questions. Seems that no questions at this end. So I've been looking forward to see my tutorial group very soon at around 2020. Oh, there are some students ask about the examination mode. Yeah, we need to use 2 devices, a lockdown blower during the final exam. Yeah, that's right. So it will be a closed book examination. Any more questions? We will do the revision in, I think, in lecture 13. The lecture 13's class test will change to class revision. So I hope you could join that. Some students asked that, the final examination date will be May the 6th. I cannot tell you the type of questions, but the questions formality would be like in the question style, the questions, and then there's no multiple choices, just the questions. And can we use a search device to record our answers before submission in case of equipment or network problems? I don't think that is allowed. Only 2 devices were allowed to use. Let me try to give you some briefing about the kind of examination. If possible, we can try to have set some mock test on the revision. So there won't be any questions, but just a mock to let you go into the exam. But we only said once on lecture 13, I think. And the testing session will be announced later. And so the class test and we say examination will be conducted using the Word format, I think. So we will send you some details right before the examination. But if there is any changes, I will try to let you know through the announcement. Okay. The question is not open-ended, but it's kind of I give you some questions and you're going to answer. I cannot give you further detail. I'm sorry for that. Will the revision section Vic 13 give exam scope or things like that? There's never examination scope, but we're going to give you the revision or some, go through from class lecture 1 to the end. So if we give you some examination scope, that would be a bit of unfair. So I want you all to look through all the examination, all the lecture slides. And then we're going to go through this from lecture 1 to lecture 12, the final lectures. There won't be any examination scope. Any more questions?
Miss, please, I have a question. So can you please check with the detail of the examination? Because if we are using a lockdown browser, we won't be able to use any applications, which means that we won't be able to type it in a Word document. Can you please confirm with that whether that is going to be the?
No, I'm sorry, we cannot confirm you because the department may have the arrangement. They're going to introduce further details, but we're going to use similar procedures that has been used in 2020, 2021. So normally they would lodge Zoom in for checking, and when the question papers will be uploaded to the Canvas 15 minutes before the class, the exams. And the password normally will be provided I think 5 minutes to 6 minutes before the class examination. And when you download it, and then you answer it afterwards. Is that what you want to ask?
Because this is we're supposed to have a closed book exam, which means that the whole thing will be processed throughout the Canvas system. So yeah, we're not supposed to have some sort of Word document because that's open book. I mean, closed book, since we're using the lockdown browser, then we will have everything online. That's what I'm trying to ask, whether we are going to use a Word document, because that thing doesn't work in this case.
Yeah, the Word is empty one, and you use 2 devices. 2 lockdown, actually, the will be lockdown browser. Is not allowed. The lockdown browser is not allowed.
Hello, Professor. So you mean we need to use lockdown browser or not during the examination?
We have to lock down browser because we use closed book. You
yes,
understand?
and when we use the lockdown browser, we cannot use Zoom to enter the meeting, and we only can use the device 2 to enter the Zoom meeting. So we can only use the lockdown browser, the quiz model, to answer the question, because we cannot download the words. Do you say? Because the lockdown browser do not allow other app at the same time.
That's exactly what I want to ask, because the lockdown browser is an application. It's not something that you can control. Once you activate the lockdown browser, we cannot use any of the other applications.
I said that lockdown browser is applied after you download the Word, after you download the Word file, but you are not allowed to use the website resources. So we will trust you that you will not use that. You understand? That's what I mean by lockdown browser. It not means that you cannot, you have to make sure the lockdown browser is applied. You know what I mean?
I understand you mean, but when we download the examination paper, and also
I said you can download the paper, you can use the Zoom, but you are not allowed to use the website searching engine because this is closed book exam. So we will have the trust system. Do you understand my answer?
Yes, we understand, but 老师，我可以用中文跟你解释一下。
用中文吧，麻烦。
就是那个 lockdown browser 用完之后，它就不可以，就是用 Word 或者是其他任何一个软件了，就是只能在 Canvas 那一个页面停留着，就是不可以在那个上面答题了什么的，就是不可以用 Word， 只可以在 Canvas 这一个页面待着。
So which means we can say the lockdown browser it can be is not applied, which means we allow you to use and the websites. We allow to use the Zoom.
Then I get what you mean is that we don't necessarily have to apply the lockdown browser.
Yeah. Don't necessary to apply, but you are not allowed to use the website. You understand?
But now I understand. But please check with the department or whatever associated unit that corresponded to this, because according to the university policy, that will be monitoring for using this sort of application. So can you please just check with them and then make an announcement to us that telling us
we can make an announcement.
Okay. Okay, thank you.
Yeah, we can make announcement with the detailed arrangement. Don't worry. Okay. Thank you for the questions. I'm sorry I have to leave the session because we've started the tutorial now. I'll see you later. Yeah, next week.